1962, a 21-year-old man began investing $500 a month into dividend-paying stocks. He never stopped. He never sold. 40 years later, that portfolio was worth $1.2 million, and it was still paying him every single quarter. Welcome to Market Mapped. Today we're going to break down dividend investing, one of the most powerful and most misunderstood strategies in personal finance. By the end of this video, you will understand exactly how dividends work, how to pick the right stocks, and how to build a portfolio that pays you every single quarter. Let us start with the basics. When you buy a share of stock in a company, you are buying a tiny piece of that business. And when that business earns profits, it has two choices: reinvest that money back into growth, or share those profits directly with shareholders. When a company chooses to share those profits, the payment is called a dividend. Here's why this matters. Most investors only think about price. They buy low and hope to sell high. But dividend investors play a completely different game. They are not waiting for the price to move. They are collecting income every quarter, like a landlord collecting rent. The price of the stock can go up, go down, sideways, and still, every 3 months the dividend check arrives. This is the fundamental shift in mindset that separates wealth builders from speculators. The dividend yield, expressed as a percentage, tells you how much income you earn relative to the price you paid. A stock priced at $100 that pays $4 annually has a 4% yield. That is 4% of your money coming back to you in cash. But a 4% yield alone is not what creates millionaires. The real weapon is what happens when you reinvest those dividends. This is called a dividend reinvestment plan, or DRIP. Instead of taking your dividend as cash, you automatically use it to buy more shares. Those new shares then produce their own dividends, which buy even more shares, which produce even more dividends. This is compound growth, and it is powerful in its mathematics. Albert Einstein reportedly called compound interest the eighth wonder of the world. He said, "Those who understand it, earn it. Those who do not, pay it." Let us run the numbers. If you invest $10,000 in a stock with a 4% dividend yield, and the company grows that dividend by 7% per year, in 30 years you will have received over $90,000 in dividends alone, nearly 10 times your original investment, and your portfolio value will have climbed to over $76,000. That is without adding a single new dollar. Now add consistent monthly contributions, that $500 per month from our opening story, and the numbers become staggering. Over 40 years, at a blended return of 8% including reinvested dividends, $500 a month becomes over $1.6 million. The investor in our story was not lucky. He was patient. He understood that time, not timing, is the real edge in dividend investing. Every month you wait to start is a month of compounding you will never get back. So how do you pick the right dividend stocks? Not all high-yield companies are created equal. Some of the most dangerous investments look, on the surface, like incredible opportunities. The first rule of dividend investing: if the yield looks too good to be true, it probably is. A 12% dividend yield on an unstable company is a trap. The company is likely paying out more than it earns, or it is borrowing to pay dividends. Both of these are red flags that end in dividend cuts. And when dividends get cut, stock prices typically collapse, giving you the worst of both worlds: less income and a falling portfolio. The metric you need to master is the payout ratio. This is the percentage of earnings a company pays out as dividends. A healthy payout ratio is typically between 40 and 60%. That leaves room for the company to invest in growth, weather recessions, and still pay you reliably. Beyond payout ratio, you want to look at 3 more factors. First, dividend growth rate. Companies that consistently raise their dividend year over year show financial strength and management confidence. Second, free cash flow. The actual cash the business generates after all expenses, because dividends come from cash, not accounting profits. Third, debt levels. Heavily indebted companies can be forced to cut dividends when interest payments rise. Run these 4 screens on any stock before buying it for income, and you will eliminate 90% of the dividend traps that catch amateur investors. But what if you want a shortcut? A pre-screened list of companies that have already proven they can sustain and grow dividends through recessions, bear markets, and global crises. Meet the dividend aristocrats. This is an elite group of S&P 500 companies that have increased their dividends every single year for at least 25 consecutive years. Not maintain them, increase them. Through the dot-com crash, through the 2008 financial crisis, through a global pandemic. These companies kept raising their payouts to shareholders. As of the latest count, there are approximately 65 companies on this list. Names you likely already know: Johnson & Johnson, Coca-Cola, Procter & Gamble, Colgate-Palmolive, Automatic Data Processing, Genuine Parts. These are not exciting companies. They do not make headlines. They do not have celebrity founders. But they have done one thing, quietly and consistently, for a quarter of a century. They have sent their shareholders a bigger check every single year. Historically, the Dividend Aristocrats Index has outperformed the broader S&P 500 over long periods with lower volatility. That is the rare combination investors dream about: better returns and less risk. So how do you actually build a dividend portfolio? Here's a simple 4-step blueprint you can start implementing this week. Step 1. Open a brokerage account that supports DRIP, automatic dividend reinvestment. Most major brokers offer this for free. Step 2. Build a core of 5 to 10 dividend aristocrats across different sectors: consumer staples, healthcare, industrials, financials. Diversification protects you when one sector faces headwinds. Step 3. Set a monthly contribution, even if it is just $100. Automate it so you never have to think about it. Step 4. Do not check the price every day. Your dividend income is what matters, not daily price fluctuations. Track your quarterly dividend payments. As those payments grow, you will see your wealth building in a way that daily price watching never shows you. The goal is simple: reach a point where your dividend income covers your expenses. When your dividends pay your bills, you are financially free. Dividend investing is not exciting. It is not a get-rich-quick scheme. It is a quiet, methodical accumulation of ownership in great businesses, and then letting those businesses pay you back for decades. The investor who started with $500 a month in 1962 did not discover some secret. He simply understood something most people never do. Wealth is built quietly, one dividend at a time. If this video opened your eyes to the real power of dividend investing, subscribe to Market Mapped. We publish deep dive investing research every week, the kind of analysis that actually moves the needle. Hit that subscribe button, and we will see you in the next one.